Have you ever thought about becoming your own bank? Well, here's a few reasons why you should. What's good, everybody? It's Vaughn, and this is where you get that knowledge that you don't get in college. So go ahead and scroll into the description, click the link next to Weeble, and collect your 12 free stocks. Word on the street is that they got this new product that's paying dividends that's higher than the APY at any bank. It's a concept that might be new to you, but wealthy people have been using this for years. Some people know it as becoming your own bank or bank on yourself, but it's most popularly known as the infinite banking concept. Now, I want you to take a look at this clip so that you get a better understanding of exactly how it works. For those of you that watch this video all the way through, I'll provide a sweet treat at the end just for being a good friend.
Okay, let's talk about how to control your wealth. First, we start at your income. You probably receive money from either your job, or maybe you're a business owner. Maybe you're retired and you receive a pension, or maybe you were lucky and you got an inheritance. In either case, monthly or bi-monthly, you receive a paycheck. Now, when you get that paycheck, there's really only 4 things you can do with it. You can save it, you can invest it, you can spend it, or you can give it. Well, what if, before we did those things, we first put that money into an area, a place that we control completely? Let's call this place your family bank. Now, when your money is inside your family bank, you earn dividends. You earn guaranteed growth for life. It's private. You control it. You earn tax-free growth. You can leverage it and put your money at work in more than one place at a time. You receive protection in the form of a death benefit in case you die, and from creditors in case somebody tries to sue you. Your money is protected. And there's zero market volatility. And what does that mean? That means there's no losses ever. There's also opportunity, because when you have money, opportunity will find you. So you can use that money for investments, or maybe big purchases such as a car or college tuition, maybe a wedding. Then, when you want to access that money, because it's liquid, you take it out and you can invest, spend, and give with it. Okay, we got that part. But how do we do this? Well, it's kind of like a mortgage. So if you're familiar with home ownership, you understand that you make monthly mortgage payments to the bank. With each payment, a portion of that goes towards the principal balance of the home, and you build equity. Now, when you have enough equity built up, the bank may grant you a home equity line of credit where you can access that equity and use it for whatever you want. Now, the family bank operates a lot like this, except with a few distinct advantages. One, with the family bank, you own it, which means you control it. 2, it's always guaranteed to increase, unlike your house. And 3, there's no required repayments. Okay, so what product are we talking about here? Well, you may have heard of it before. It's called whole life insurance. But more specifically, we use a specially designed life insurance contract, something you've probably never seen before. How it works is you capitalize your policy with premium payments. With each premium payment, a large portion of that goes towards cash value in your policy. Once it's in there, it's locked in for good. It can never decrease in value, and it will never come out of there. Now over here, we have a separate pot of money. This money are reserves held by a mutually owned life insurance company. Now, what does mutually owned mean? Well, simply put, you own the company, not stockholders, but you, the policy owner. Now, when you want to access your cash value, you take a loan from the other pot of money and collateralize it with your cash value. No questions asked. You can spend that money however you see fit. And then you create your own repayment schedule. All the while, your cash has been sitting safely and securely inside that policy, enjoying all the benefits we discussed above. So that's it. That's how you can control your own wealth. If you want to learn more, I recommend buying this book, Becoming Your Own Banker by the late R. Nelson Nash.
Just to make things clear, infinite banking is a concept by which you're overfunding a whole life insurance policy or an IUL. Some people don't recommend using an IUL for the infinite banking method, and others say it's much better than a whole life insurance policy. But that's up to you to do your research so that you can make a calculated decision when it comes to structuring your own policy. I personally use a whole life insurance policy for the infinite banking method. I started my policy a little bit over 5 years ago, and I've seen consistent growth throughout the duration of time that my policy has been enforced. I think it's important to note that in order for the infinite banking method to actually work, it has to be done correctly. There's 4 critical components of the infinite banking concept. I'm only going to focus on using the infinite banking method with a whole life insurance policy because that's the only one that I have experience with. 1, the policy has to be structured correct. When it comes to structuring your policy, there's 2 components that you have to pay close attention to: the premium and the paid up additions rider. The name of those riders differ per institution, so you have to deal with the life insurance agent that is familiar with the infinite banking concept. If the life insurance agent is just selling you a regular whole life insurance policy, then all of the money that you're contributing is going to go towards the premium. But in order to supercharge that policy so that you're able to see funds in your cash value from day one, you have to add a paid up additions rider. And the way that they'll do that is by lowering your premium and contributing more to the paid up additions rider. But based on the amount that you're contributing to the premium, there's only a certain amount that you can contribute to the paid up additions rider. So you have to deal with an agent that knows how to create this type of policy. Number 2, do not exceed your MEC limit. MEC stands for Modified Endowment Contract. When you start your policy, you agree to contribute a certain amount on a monthly, semi-annually, or annually basis. And based on the amount you agree to contribute, there is a MEC limit created, which will approximately be a few thousand more than your annual contribution. So for example, let's say you contributed $10,000 to your policy on an annual basis. Your MEC limit will be right around $12,000, which means that you shouldn't contribute more than $12,000 to your policy on any given year. And anything that you contribute over $10,000, so if you were to contribute at $12,000 on 1 year, that would go towards your paid up additions, and that would go directly towards your cash value. Number 3, to be on the safe side, you shouldn't borrow more than 80% of your cash value. You want to leave some of the cash value in your policy so that it doesn't cause your policy to lapse. When you borrow from your policy, you don't technically have to pay those funds back, but it's a good practice to do so because it essentially serves as a revolving line of credit. You can borrow from your policy, and once you pay it back, you can borrow those funds again and reinvest it. And that will allow you to continue to leverage your policy to acquire more assets and grow your wealth. And number 4, in order for the infinite banking concept to actually work, you have to acquire income producing assets, such as real estate, stocks, funding a business venture, acquiring commodities. Your policy should serve as a tool that you're leveraging to increase your wealth because it's better for your health. You do not want to borrow from your policy to purchase liabilities. If it doesn't produce an income and then some, then it is not something that you would want to leverage those funds in order to fund. I remember just a few months ago, I went into Truist Bank in order to complete the paperwork for a business line of credit. And as I was talking to the representative, he was telling me more about his other products like the business credit cards, the personal credit cards, and the personal line of credit. And he was saying that the interesting thing about their personal line of credit product is that you could get approved for up to $50,000 and all you have to provide is proof of funds. And that got me to thinking. So I asked him, would I be able to use the cash value of my life insurance policy? And he said yes. And he told me that they wouldn't even use the life insurance policy as collateral. They would just use it as proof of funds. So that situation helped me to understand that my life insurance policy is a legitimate asset. There are other banks out there that offer personal line of credits, and they would use the cash value in your life insurance policy as a security against that loan, and they'll give you a much better interest rate. But here at Truist Bank, he was saying that they would approve me for the personal line of credit, and they wouldn't even use my cash value as a security. The infinite banking concept is something that you really want to gain an in-depth understanding of before you pull the trigger. And it's not something that you're going to understand from just one video. And since you made it this far and you're still in your seat, I told you I got a treat. So if you scroll into the description, I'm going to leave the link for the book Bank on Yourself by Nelson Nash. So you can get your free copy, and it will help you get a much better understanding of the bank on yourself method. If you have any questions, go ahead and leave them in the comments below. If you like this video, give me a thumbs up, and don't forget to subscribe and click the bell so that you're notified every time that I make a new post. Until next time.